Gold is in a correction phase as well as silver. I'm not selling my gold. When the market goes up, you have correction periods, like say in 87. In retrospect, it was a correction in a bull market. I think that yes, the money can flow elsewhere and it can flow into hard assets such as gold, silver, and platinum. But I wouldn't bet on it right now. These upward cycles can be interrupted by short-term cycles that reduce the rate of inflation and reduce the interest rates for a while. The S&P has never had such a low dividend yield. I think the rate of cost of living increase is much more than 4%. I think ordinary people struggle. They live paycheck to paycheck. They have large installment credits. They have large margin debts. The margin debt is the largest ever, 1.3 or 1.4 trillion dollars. So they like everything that reduces inflation, especially when they get benefits from the government.
Yes, that is the worry. So what is a safe haven here if they're going to be a sort of cash?
But as you know, I'm an advocate of people owning gold. Now, I haven't talked much about gold because I think, this is my view and I may be wrong, and I haven't sold my gold. But personally, I think that gold is in a correction phase as well as silver, and that it may last for a while because of this reduced liquidity growth. So we could have a correction in gold that lasts until, say, September, October, but maybe not. I'm not selling my gold. I'm just looking at charts, and my sense is that the action of gold is not that great, the market action. Whereas, as I mentioned before, what strikes me at the present time is the exceptional strength of financial stocks and the emerging strength of home builders. And I observed the strength of home builders, not just in the US, but also in emerging markets.
So time frame is always important here. And so you're watching those two sectors because you think the market is signaling that bond yields are going to move lower?
I think if I look at the 70s, interest rates on the 10 years started the 70s at 6%. And they went up to 15.84% in September 1981. Okay? So we had a sharp increase in interest rates. But in between, sometimes the 10 years note, the interest was cut in half by 50%. Because there were bond market rallies.
Markets often whisper the truth months before headlines admit it. Marc Faber notes that temporary bond rallies can emerge even during long-term inflationary cycles, a distinction many investors ignore. That nuance explains why financials and home builders may strengthen, while gold pauses without ending its broader bull thesis. Missing the timing often hurts portfolios more than choosing the wrong asset. Next, Marc Faber reveals why today's rate cycle resembles past turning points far more than investors realize.
You understand? When the market goes up, you have correction periods, like say in 87. In retrospect, it was a correction in a bull market. And then we had the 1990-91 correction in America. And then we had the 98 correction. And then in 2000, the market went down to 2002, 2003. Then we had the bull market until 2007, 2008, and a steep correction. And then the bull market until 2020, again, a steep correction and up again. And interest rates are the same. They go up and then they come down and then go up. So they move in long cycles. My view is that the interest cycle peaked out in 81. Interest rates dropped until August 2020. And since August 2020, we are in an upward cycle for inflation and interest rates. But these upward cycles can be interrupted by short-term cycles that reduce the rate of inflation and reduce the interest rates for a while. But the trend is upwards. That is my view. Now you may say, Mark, you're crazy. Yeah, maybe that's what many people think. But you have to have sort of long-term view. And you asked me about my long-term view. I would be very cautious about financial assets at the present time because they're incredibly overvalued. The S&P has never had such a low dividend yield. And the PEs are in the sky. Nowadays, companies don't measure the price earnings ratio, they measure price to sales.
Record equity valuations rarely coincide with genuine long-term safety. According to Marc Faber, history shows that secular trends survive multiple sharp corrections, yet investors repeatedly mistake temporary recoveries for permanent stability. Wall Street celebrates expanding valuations while quietly abandoning traditional measures of value, exposing a widening gap between price and underlying fundamentals. Wealth built on optimistic assumptions can disappear faster than expected. Next, Marc Faber exposes why today's valuation metrics contradict the market's confidence.
Exactly. So, but shorter term within that, you do like financials and home builders, and you do see a short-term move down in yields before it resumes.
Yes, for next 6 months. I think
the next
it's
6
possible.
months.
I think the economy is much weaker for the ordinary people than the government claims. I think the rate of cost of living increase is much more than 4%. I think ordinary people struggle. They live paycheck to paycheck. They have large installment credits. They have large margin debts. The margin debt is the largest ever, 1.3 or 1.4 trillion dollars. And that has to be paid one day. You understand? It can expand. In a bull market, the margin debt expands. But when the bear market comes, the margin calls occur. And the leverage, you look at the trading activity in ETFs and in single stock ETFs and in futures, it's incredibly big. And this trading activity comes from all over the world. People in Korea, in Taiwan, in China, they buy Micron technology and Nvidia and Tesla and SpaceX.
Yeah, the levered ETFs, the volume on the levered ETFs attached to SpaceX is off the charts. And, you know, that sort of speaks to what you're talking about. If that is the case, you mentioned the U.S. rolling over, and back when we saw it happen to Japan, the money left Japan and went to the NASDAQ. If the U.S. stock markets roll over, does that money go elsewhere globally, or does it take the whole global market down with it?
The most dangerous leverage is the kind investors stop noticing. What Marc Faber is highlighting is that margin debt near record levels has become embedded across ETFs, futures, and speculative technology trades worldwide. Official inflation may read 4%, but household budgets often tell a very different story through food, housing, insurance, and debt payments. When liquidity reverses, leveraged positions become forced sellers, not long-term investors. Next, Marc Faber exposes where institutional capital could flee if US equities finally crack.
Well, up to now, it's gone into value stocks. Value stocks have outperformed the S&P, and they have outperformed growth stocks. And emerging markets, funnily, have also begun to outperform the US over the last 12 months. So it's possible that the money will flow into some emerging markets that have become actually cheap. Say you look at Indonesia. Of course, not the whole world can invest in Indonesia. But the stocks in Indonesia are now rather inexpensive. They're also inexpensive in Thailand. In my view, there's nothing particularly good about Thailand, but there are some aspects that would argue for having investments in Thailand at the present time. So I think that, yes, the money can flow elsewhere and it can flow into hard assets such as gold, silver, and platinum. But I wouldn't bet on it right now. I think we had a big move in gold and silver last year and at the beginning of this year until essentially the end of February. And since then, we're in a correction phase. And I think it will go on for a while. But I'm a believer that the US, and we discussed this about 10 minutes ago, does not have much options not to print money. You understand? This is, the pain on the ordinary American and the pain on the capital market, on the stock market of tight money at the present time would be far larger than the pain that Volcker inflicted on the US when he increased interest rates to fight inflation.
Capital is already moving before most investors notice the rotation. Marc Faber's argument suggests that value stocks and select emerging markets are attracting attention because relative valuations have become difficult to ignore. The more important signal is that policymakers have limited tolerance for prolonged tight money when debt levels and asset prices are this elevated. For savers, the real risk is assuming the system can endure Volcker-style restraint again. Next, Marc Faber reveals why future money printing may matter more than today's correction in gold.
Because at the time, the financial market was tiny in comparison to today. So it had an impact on the economy, yes, for sure. There was a recession in 80, 81 and 82, but it wasn't as devastating as it would be today. I mean, today, the tight monetary policies of Volcker would be a complete disaster.
Oh, it would be worse than a depression, I would imagine, which is why I think we haven't seen them be able to pursue, the policies, as you say, that some would like to see. What do you think is either the risk or opportunity that's most underappreciated by investors right now?
Their highest risk is that financial assets and other assets are grossly inflated. I mean, you see, the concept of inflation is difficult to understand for ordinary people because when the stock market goes up, they say it's a bull market. But basically, it's an inflation of asset values, of financial asset values. And profits, corporate profits, they, of course, benefit from monetary inflation, from the increase in the quantity of money. It boosts profits. It boosts the household net worth. And all these things, they have a positive impact on the economy. But then the consequences of all this comes in the form of price increases at the supermarket and the price increases for the schools of your children and healthcare price increases at hospitals and so forth and so on. And that we call consumer price inflation. But it's caused by monetary inflation also, but it's a different sector of the inflationary environment. And that people don't like.
The biggest inflation is often the one investors celebrate. This is where Marc Faber's thesis shifts from market timing to monetary mechanics. Rising asset prices are themselves a form of inflation fueled by expanding liquidity. Wall Street treats soaring stocks as wealth creation, while households eventually face the consequences through food, healthcare, education, and housing costs. Ignoring that link leaves portfolios exposed to both valuation risk and purchasing power erosion. Next, Marc Faber unravels why asset inflation and consumer inflation are two sides of the same monetary cycle.
So they like everything that produces inflation, especially when they get benefits from the government, the subsidies. So, and child benefits and social security, all these things. These are inflationary factors. A government deficit, a government deficit is inflationary, period. The economy has been financialized. There's no question about this. About the failure, of course, markets will eventually assert themselves. And in my view, the US is heading towards a fiscal crisis because the deficits are very hard to reduce in a democracy. A politician who goes to the people and tell them, look, we made mistakes in the past and therefore you have to now tighten your belts. You have to work more, pay higher taxes, and you will get less benefits, is unlikely to be elected in a million years. That I guarantee you. The politicians who go and tell, oh, we're going to give you this benefit and that benefit and subsidize your children and give you free health care and God knows what, they are going to be elected. And
that's not just a U.S. situation, right? We've seen sort of populism on the rise across the globe, wherever any kind of election's held.
Correct. This is not unique or endemic to the US. Europe, in some European countries, it's even worse. But I have to say, in most emerging economies, this is not the case because we don't have entitlement programs.
Governments keep promising more benefits while warning that inflation is under control. According to Marc Faber, persistent deficits, subsidies, entitlement expansion, and fiscal spending all push the monetary system toward greater inflationary pressure over time. The contradiction is obvious. Policymakers encourage spending while central banks claim they are fighting inflation. For investors, the danger is assuming political incentives will suddenly become fiscally disciplined. Next, Marc Faber exposes why democratic governments struggle to reduce deficits even when the debt burden becomes unsustainable.
You understand, in the US, first of all, the debt situation is very high. And the interest on the government debt in the US is unlikely to go down because the deficits are large and add to the government debt every year. The interest rates are unlikely to go down because the inflationary pressures, with or without oil going up or staying at the high level, the inflationary pressures are for real. And I would expect food prices to continue to go up. So the Fed cannot actually lower interest rates considerably at the present time. I have people like Shadow Stats, John Williams, who calculate the inflation rate in May, the consumer price index, at 12.5% per annum. And all your viewers, I guarantee you, they don't live with an inflation of 4% per annum. They live with an inflation of something like between 6 and 12%. For sure. For sure.
It's funny because we as we are speaking, Kevin Warsh is going to head his first meeting, and a lot of people expect him to come out and say that inflation is, he's not going to use transitory, but is transitory. It's and we already see oil prices coming down, and that they are going to find a way to be able to consider a rate cut. You think that's fantasy?
Well, look, there are two Kevin Warsh. The one is The Economist. I have a high regard for him as an economist, and I think he's at heart potentially an outstanding Fed chair. But he's also working for the Trump administration.
The market wants rate cuts, but the debt market may refuse to cooperate. What Marc Faber is highlighting is that persistent deficits and rising government interest costs can keep inflationary pressure alive even if oil prices temporarily retreat. Investors focus only on headline CPI risk, missing the broader cost of living trend that households continue to experience. The timing matters because expectations for easier policy may be arriving before inflation has truly cooled. Next, Marc Faber reveals why politics could complicate the Fed's next move.
And the Trump administration, one of their objectives is to get good election results in the fall, in the midterm elections. And that's why Trump is so keen to end the war, because the war in Iran is about the most unpopular war in the US. But people think, rightly, why are we there? What are we actually doing there? And so Trump, he wants to finish the war, but he also wants to do something against inflation, because people see it. The tariffs increase the rate of inflation or increase the price level that the consumer pays in the department store and the supermarket and at drugstores meaningfully. And it increased interest rates, whereas people had expected interest rates to go down. That's why homes and cars are relatively unaffordable, because the interest rates have gone up. The mortgage rate is currently still above 6%. So it's not exactly a bargain. And in my view, Walsh is, as an economist, he would like to increase rates, but as a politician and in the administration, it will be difficult for him to raise rates. Difficult. But he can do it. He should do it, because if he doesn't do it, I think that the price level in America will rather go up further than down.
The clearest signal is not what politicians say about inflation, but what they need before an election. Marc Faber notes that tariffs raise consumer prices, while mortgage rates above 6% keep homes and cars unaffordable for many households. That creates a policy trap, where political pressure favors easier conditions even if inflation remains stubborn. Investors should watch actions, not speeches, because election incentives often outweigh economic orthodoxy.